Welcome back to another episode of Investing Explained. Here's today's question. This is such a wonderful question, and it's something that investors are really considering right now. Bonds have been attractive for a long time, since 1981. Because you see interest rate drop, and because of that, returns have really been great for long-term bondholders. Today, as you point out, interest rates are really low. You might even be wondering, why are so many investors still holding bonds? Now, you do have many insurance companies and pension funds that have to do that because that's simply how they're regulated. That is due to a principle called duration, and they simply have to ensure that they have enough funds where they can expect to meet a certain amount of claims. Another reason is that many investors like to have low volatility in their portfolio, and fixed income instruments such as bonds are just a much better way of ensuring that than something like stocks. Now, my response so far has really been in so-called nominal numbers, not in real numbers. In other words, you need to account for inflation. So when people talk about double-digit returns on bonds in the 1970s, well, inflation was double digits too, so just because you might hold a, say, 50% return bond, if inflation was the same, yes, the bond would be better than holding cash, but your purchasing power didn't change. You will be making 50% more and everything would be 15% more expensive. So what I'm worried about right now, and I think that's also what you're hinting at, is that what happens if we account for inflation? Because unless we enter a prolonged period of deflation, bonds would likely not be as attractive in real returns compared to many other asset classes. So when you ask whether we would see a new normal with a high Shiller PE, you can say that we're already there to some extent. The Shiller PE is very high right now, and a part of that reason is because the Fed is printing so much money and keeping a 0% interest rate, and that just drives up the price of stocks. Asset classes should not only be seen in the light of nominal numbers, but rather investors look at what's the opportunity. And if you get 0% on your bonds, suddenly a low to mid single-digit return in equities might seem appealing. Now, whether or not it's a new normal, it really depends on how you define a new normal, because as we enter the next interest rate cycle, and just to be completely upfront, I have no clue whenever that will happen. If you have higher interest rates, then suddenly bonds and stocks change in value, because stocks becomes less attractive because you can now get a higher return in bonds. And bonds also changes value. If you locked in long-term bonds at the current price level, your bonds will drop in value as the interest rate go up. But it will, on the other hand, become more interesting to buy new bonds that are now paying a higher interest rate. So going back to what you said before, what do you do as a retail investor? Well, if you're looking to compound your purchasing power, you do have a leg up compared to, for instance, pension funds, insurance companies like I mentioned before, because you do not need to hold long-term bonds. And if you like to have less volatility in your portfolio, you can buy short-term bonds, which won't drop in value if you see an increasing interest rate. And if you do think that interest rate stays long for a long period of time, you might consider looking into stocks instead. And if you're worried about inflation, you might also include a gold component. So Jim, I know I covered a lot of ground here, and it is a tricky question that you ask because it's very important to say, based on what's happening today, bonds are not attractive, but you do need to factor in what's going to happen in the future. And that determines the value of the bonds and the decision that you make today. And you might have heard the quote that it's very difficult to predict, especially about the future. If I can even add to that, it's even harder to predict what's going to happen with the interest rate.
From my vantage point, the question you're really asking is, how can I continue to measure something whenever a ruler doesn't exist anymore? Because for all these years, that's how we've looked at the fixed income market, particularly the 10-year treasury, because that was always your ruler as to how you were measuring your returns above that risk-free rate. So if the risk-free rate is 0, how in the world can I measure anything? And the expectation that I have moving forward that on a global scale, I think central bankers are absolutely going to try to implement this MMT where they're going to try to take rates negative. Now, the question really for me becomes, are they able to do that and for how long are they able to do that, if they are able to do it at all. And for that, and I think that's what Stig's getting at, is like, how in the world can you possibly answer that question? Because it's never been done before. This is implementing negative interest rates across people, like, hey, give me some money and I'll guarantee you that I give you back less. That's never been done before. Now, does that mean it can't be done? Probably not. Who knows at this point? I do know one thing. If they go down that path, they've got to get rid of the hard currency that you have in your wallet, because what people are going to be incentivized to do is to go take out as much of that at the bank as possible, put it in a safety deposit box, because you'll get a higher return than if you do it digitally with your checking account. We're not there yet, but all trends indicate that that's where they're trying to move things. The reason they're trying to move it there, the root as to why they're trying to move it there, is because they can't allow interest rates to go up because of the fiscal spending that's happening, not just in the US, but all over the world. So how do you deal with this as an investor? What it really comes down to is you need sound money. You need something that can't be debased. I think what you're seeing in the stock market right now is just that. There are people that are bidding the value of certain companies that can protect their enduring competitive advantage, even in a depressed scenario. Those companies are just bidding at levels that don't even make sense, historically speaking, based on the earnings that the companies have created. Everyone in the markets' minds are exploding right now. Well, how is this possible? Why is this happening? Well, I think it's happening because people are treating that stock, that equity, as if it's sound money. I think an important consideration to have is you need to own something that doesn't have counterparty risk. When you think about debt, that has a counterparty risk. When you think about equity, it does not, unless you're playing in the derivatives market, right? But if you own the stock, that does not have the counterparty risk. So now if the company decides to debase or to create more shares of stock, it's kind of like what you're seeing with Tesla. That's a whole different story. That has, I guess you could argue that has a counterparty risk because decision makers are debasing the stock. But you need to find something that has sound footing, that is profitable, that is going to perform well in a deflationary environment. And you're seeing a lot of that in the tech stocks, and that's why they're running. Does that mean they're going to continue to run? I have no idea. I would suggest using some type of momentum strategy on those types of companies in order to protect your downside risk. I don't really know how else a person can navigate this crazy central banking induced volatility environment that we're dealing with, other than treating it from that perspective, because we've pretty much taken the ruler, snapped it across our leg, and thrown it in the trash can, which is your risk-free rate. So that's the best I can do for you. I would tell you to try to get smart on momentum strategies, and then focus on those companies that are going to continue to perform in a depression-like scenario, that have earnings so that they don't debase their stock or dilute their stock. Those are the ones that I'd be looking at.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.